Hey traders, welcome back to Smart Trading Tactics. If you haven't subscribed yet, hit that subscribe button and tap the bell icon so you don't miss out on any of our trading tips. Today, we're diving into a crucial concept that can transform your trading strategy: inducement zones. Let's get started. What are inducement zones? Ever found yourself faced with multiple potential zones to trade from and felt unsure which one to choose? It's a common dilemma, and picking the wrong zone can lead to losses and missed opportunities. In this video, I'll break down the concept of inducement and show you how to leverage it to your advantage. When the market trends in a clear direction, like a bearish downtrend, you might see several zones to consider for shorting. This is where inducement zones come into play. Let's look at this chart. We have an inducement zone marked in red and a true zone marked in green. An inducement zone is essentially a trap. It looks appealing for trading but often fails to hold. For example, this red zone might entice traders to short, but it often gets bypassed as the market moves towards the true zones, resulting in larger movements. So why does this happen? It's all about liquidity and imbalance. Imbalance refers to price ranges that haven't been retested. If the price had pulled back and tested this supply zone, it might have been a good shorting opportunity. However, the imbalance creates a liquidity pool, including stop losses from sellers and buy stops from breakout traders, as well as institutional orders. Large market movements are typically driven by institutional orders, not retail traders. Because of the liquidity and imbalance, the market is less likely to respect the inducement zone and will often push higher to fill orders in the higher supply zone. You might think of placing sell limits at both the inducement and higher zones, but this approach can lead to multiple losses if neither zone holds. Instead, focus on the most promising zones by applying your understanding of inducement. Let's examine a real chart. We have several potential demand zones. We need to determine which one is the best for buying. We have a demand zone here, another slightly lower, and an extreme zone further down. Let's analyze these. First, we can rule out the top zone. There's clear imbalance beneath it, leading us towards the lower demand zone. This makes the top zone a low probability buy. Now we compare the middle and extreme zones. The middle zone seems promising because of the imbalance underneath, but we need to consider market structure. Looking at the market structure, previous high failed to break and was rejected, indicating that this middle zone may not be strong enough. On the other hand, the extreme zone had a valid higher high, showing more strength. The low demand zone didn't break into a new structural high, so it's not as strong as it seemed. The middle zone, however, shows more promise. We can keep the low zone in mind if the market breaks lower and provides confirmation, but the middle zone is the stronger choice. When the market enters the demand zone, look for confirmations on lower time frames. For instance, on the 15-minute chart, watch for a bullish momentum after a small push through the zone. This validates the buying opportunity. Set your buy orders above the demand level. Place stop losses below the low and target previous highs. This approach ensures you're trading from the strongest zone and increasing your chances of success. To wrap up, remember to focus on strong zones and consider imbalances in the market. This will help you avoid losses and trade with confidence. If you found this video useful, give it a thumbs up and share it with other traders. Don't forget to subscribe to Smart Trading Tactics for more insights. Happy trading, and see you in the next video.